Welcome back. If you're joining me live, let me know where you're watching from, and if you're watching it on the replay, drop replay in the comments because today's topic is one that almost every real estate investor gets wrong. Most investors spend all their time thinking about how to buy properties and how to reduce taxes while they own them. But very few people spend enough time thinking about the exit. And here's the reality: you don't make real wealth just from buying great properties. You build wealth from making smart decisions when it's time to access that equity. Because eventually every investor reaches a crossroad. Do I sell? Do I refinance? Do I keep holding? And the answer isn't always what you think. In fact, I have seen investors pay hundreds of thousands of dollars in unnecessary taxes simply because they didn't understand the tax consequences of each option when they exit. So today I want to walk you through how sophisticated investors think about these decisions. And let's start with selling. A lot of investors assume selling is the natural next step once a property has appreciated. And the property went up in value, real estate investor made money, time to cash out. Sounds simple, right? But the IRS has a different opinion because when you sell investment real estate, you are potentially triggering several different taxes at the same time. First, you may have capital gains. Secondly, you may have depreciation recapture tax. And depending on your income level, you may also have the net investment income tax. So imagine you bought a property for $500,000 and later it worth $1 million, and you think you're sitting on a $500,000 gain. But after taxes, the amount you actually keep can be dramatically lower than expected. That's why so many investors get surprised when they see their tax bill after a sale. Now, does that mean selling is bad? Not at all. Sometimes selling is absolutely the right move. Maybe the market has peaked. Maybe the property no longer fits your goals. Maybe you're just simply tired of managing it. Maybe you have a better investment opportunity waiting for you. Selling is not wrong. Selling without a plan is what becomes expensive. Now, let's talk about refinance. This is where things get really interesting. And one of the most powerful tax strategies in real estate is understanding that borrowed money is generally not taxable income. Again, borrowed money generally is not taxable income. So let's say your property has appreciated substantially. Instead of selling and paying taxes, you refinance. You pull out some of that equity. Now you have cash in your pocket. But because it's loan proceeds rather than income, you will not create a taxable event. This is one reason wealthy real estate investors often hold properties for a very long period of time. They are accessing equity without triggering a sale. Now, of course, refinancing isn't free money. You still have debt, you still have payments, you need strong cash flow. The property has to support the finance. But from a tax perspective, refinancing can be dramatically more efficient than selling. Then let's talk about the third option, holding. And honestly, holding is often the most underrated strategy of all. We live in a culture that constantly talks about buying and selling. But some of the wealthiest real estate investors simply buy great assets and keep them for decades. Why? Because while they're holding, they continue to collect cash flow. They continue to receive depreciation deductions. They continue benefiting from appreciation of the property. And perhaps most importantly, they are not triggering capital gain taxes every few years. Now, that's where things become really powerful. Many investors don't realize that if they hold appreciated real estate assets until death, their children or grandchildren may receive what's called a step up in basis. This means Decades of unrealized appreciation can potentially disappear for income tax purposes. Think about it for a second. Investor could own a property for 30 years, watch it appreciate substantially, and never pay tax on that appreciation while holding. He can access equity through refinancing, just like we discussed a few minutes ago, and potentially pass it to his kids or grandkids with a step up basis. This is why exit planning isn't really about deciding what to do next year. It's about deciding what are you trying to accomplish over the next 10, 20, or even 30 years. And that's the mistake I see most often. People ask what's the best tax strategy, but that's actually a wrong question. The better question would be, what am I trying to accomplish? Do you need cash today? Do you want passive income? Are you trying to grow your portfolio? Do you want to leave assets to your children? Or do you want to retire in 5 years? Because the answer determines whether selling, refinancing, or holding makes the most sense. And tax plan should support your goals. Your goals should never be dictated by taxes alone. And that's where real planning comes in. The investors who pay the least tax over their lifetime aren't necessarily the ones finding the most deduction. They are the ones making intentional decisions years before exit occurs. They are planning before the sale, before the refinance, before their retirement. And that's exactly why proactive tax planning matters so much. By the time you're sitting at the closing table, many of the best tax saving opportunities are already gone. Tax planning should happen before the transaction, not after. So here's my question for you. If you had a property that doubled in value tomorrow, would you sell it? Would you refinance it or keep holding it? Drop your answer in the comments. I would love to see how everyone thinks about this. And if you're not sure whether you're sitting on a future tax problem, that's exactly the kind of thing we help clients to evaluate. Sometimes a simple review of your portfolio can uncover opportunities to save tens or even hundreds of thousands of dollars over time. We have put a checklist for real estate exit planning that helps investors evaluate whether selling, refinancing, or holding makes the most sense for their situation. If you would like a copy, comment checklist and we will send it over. And thanks for joining me today. I will see you next week for another 15 minutes of tax saving strategies that can help you keep more of what you earn and build wealth more efficient. Have a great day.